Welcome to Call Wiz, where we break down earnings calls. Today we are on Amazon's second quarter of fiscal 2026, the July 30th call with Andy Jassy and Brian Olsavsky. This one was loud on AWS and CapEx, and quieter than people might expect on pure store financials.
Yeah, and Jassy's tone was basically, we are still capacity constrained and we are fine with that. Not the usual corporate shrug.
Scoreboard first, four numbers. Worldwide revenue $200.6 billion, dollars, up 20% year over year. Foreign exchange neutral, basically the same. Street was around $197 billion, dollars, so a clean beat. Operating income $27.5 billion, dollars, up 43%.
That operating income has roughly 1.2 billion of help, 600 million in tariff refunds, mostly North America, and 600 million from an energy contract fair value gain in AWS. Strip it and the quarter is still strong, just not quite the headline leap.
Third is AWS, growth of 36.7%, fifth straight acceleration quarter, fastest in 18 quarters, and they added over 4.6 billion of revenue quarter over quarter, about 80% bigger than their prior record step up. Fourth is the margin story. AWS operating income 16.6 billion, margins up 650 basis points year over year, or 520 excluding the derivative gain. Street was not really set up for AWS this strong and this profitable together.
So the engine is AWS plus AI, not a Prime Day sugar high alone, even though Prime Day did shift into 2Q for most big countries, including the US.
Segments back that up. North America 116.2 billion, up 16%. International 42.2 billion, up 15% ex foreign exchange. AWS also 42.2 billion and growing more than twice as fast. North America operating income 9.1 billion at 7.9% margin. International 1.7 billion at 4.1%. Paid units up 17%, Prime still growing double digits.
Stores did the unglamorous work: robotics, shorter distances, better consolidation. They still ate higher fuel from the Middle East situation and tighter driver capacity, but the April FBA fuel and logistics surcharge offset some of it. Olsavsky was careful. Cost to serve progress is deliberate, not linear.
AWS acceleration is the real plot. Jassy did not pin it on one capacity dump. Customers want the broadest Core plus AI stack, security, and operational performance, and they want inference next to data that already lives in AWS. Core gets pulled by AI because post training, reinforcement learning, and agent tool use mostly run on CPUs, and Graviton is the price performance lever, up to 30 to 40% better.
And he hit the 85% still on premises line again. That migration is the multi year backdrop. AI is the accelerant, not the only story.
Economically, AWS is a 169 billion annualized run rate business. Backlog is 496 billion, growing triple digits year over year. AI revenue run rate over 25 billion and climbing fast quarter over quarter. Chips, Trainium plus Graviton also over 25 billion run rate, also triple digit growth. Olsavsky was blunt. Profitability is not random. Efficiency, capacity optimization, fixed cost discipline.
Doug Anmuth went straight at sustainability. Everyone assumed AI would dilute margins near term. Brian said margins will fluctuate with mix and investment, but the year over year expansion is real, even after scrubbing the derivative. Jassy added that AI margins are tracking the old core path and are actually a little ahead.
That is why the stack pitch matters. SageMaker for companies building smaller proprietary data models. Bedrock for inference and model choice. Bedrock agents for the messy production layer. Memory, identity, tools, policies, payments. Then apps. Kiro for coding. Amazon Q as the work companion. Connect for contact centers. Transform for migrations and Continuum, the new security product that finds and helps fix vulnerabilities with frontier models.
The bedrock detail in Q&A was wild. The analyst noted customers spent more in Bedrock this quarter than in all prior quarters combined, and Jassy ran with the traction story. He still said Amazon can win without its own frontier model because there will not be one model to rule the world. They are building one anyway for cost control, prioritization, and speed, Within a few years, he expects at least half a dozen comparable models, one of them theirs, all in Bedrock.
Choice is the strategy. Same with Silicon. Deep NVIDIA partnership stays, Trainium gets multi year, multi gigawatt commitments from Anthropic and OpenAI, plus more startups and larger names. Graviton is in 98% of their top 1,000 EC2 customers.
Jassie's demand frame is the barbell. One end, AI labs and a few runaway apps consuming enormous compute. Other end, enterprises already getting return on investment from cost avoidance, customer service automation, fraud, productivity. The middle, existing enterprise production workloads not yet using inference pervasively, is where he thinks the largest absolute segment shows up over time.
That middle is why they will not tap the brakes. Lion's share of 2027 capacity is largely reserved, and they already have quite a bit reserved for 2028. He floated AWS as at least double a few hundred billion, and very possibly $1 trillion annual revenue business over time, with attractive free cash flow and return on invested capital once the build catches up.
Trillion is a huge claim. Context from filings. Whole company revenue was about 717 billion in fiscal 2025, and AWS is already 169 billion run rate. He is not talking next year. He is not talking next year. He is talking a long compounding curve if that middle barbell actually turns on.
Commerce is not asleep. Grocery is the sleeper needle mover. Over 150 billion in grocery GMS last year, second largest US grocer. Same-day perishables now in 2300 US cities. Monthly active perishable customers up over 50% since year start. Same-day orders with perishables average over 3 times more units. In those cities, 9 of the top 10 bestsellers are perishables.
After years of format experiments, that same day perishables model is the one that scaled. Whole Foods still outpacing comparable grocers, Daily Shop expanding fast in urban formats. Pharmacy new customers more than doubled in the first half, same day prescriptions nearly 5 times. Amazon Now, the 30-minute essential service, over 80% growth in sales and units quarter over quarter. Ads was 19.8 billion, up 26%, with Alexa for shopping engagement accelerating hard, active users nearly doubling, interactions up over 5 times. They also expect to more than double the Cardinal and Sparrow robotic arm fleet in 2026.
Cap-X is the tension. Cash CapEx was 53.1 billion in the quarter. Full year guidance moved to about 220 billion from about 200 billion, almost entirely on memory and related component inflation. Even at 220 billion, Jassy says they still will not have enough capacity for all 2026 demand, and he expects that dynamic in 2027 too.
Filings show the squeeze. Second quarter free cash flow was negative about 8.8 billion. First quarter negative about 18 billion. Full year 2025 free cash flow was only about 7.7 billion after roughly 132 billion of capex. The headwind until data centers come online line is already sitting in the cash flow statement.
His return on invested capital walk is the counter. Data center spend starts about 2 years before monetization, then 30 plus year lives. Servers and networking are bought closer to demand, break even in a little under 3 years. Useful life at least 5 to 6. And a lot of AI capacity is contracted 5 plus years. Short term free cash flow pressure, longer term multiple server generations on the same building. They are also on pace to double power capacity by end of 2027 versus 2025.
Brian Nowak asked if long lived data center spend can slow in 2027. Jassy basically said no. Too much demand already reserved through 27 and into 28. On selling Trainium to third party data centers, they are actively exploring it. Huge internal demand first, but external chip sales are a real conversation.
Zoom out, and it is one flywheel. Silicon pulls the labs, Bedrock is the catalog with governance. Agents try to solve the production last mile that stalls deployments. App layer, Q, Kiro, Connect, Transform, Continuum, creates more reason to live inside AWS. Own frontier model is optional for winning, useful for cost and control. That is a different pitch than pure GPU rental.
Colin Sebastian asked if the app layer is concerted. Jassy owned it. A lot started from internal Amazon needs, especially Q, Then external enterprises piled in across industrials, finance, auto, sports, energy. Connect is already with all five major leading airline providers, plus big banks and healthcare.
Third quarter guidance. Net sales 197 to 202 billion. Operating income 22.5 to 26.5 billion. Two clean callouts on the sequential deceleration. Prime Day timing. Last year fully in 3Q, this year mostly in 2Q. Makes 3Q growth look about 400 basis points slower than the underlying store's trend, plus about 80 basis points of foreign exchange headwind.
So if you naively compare reported 2Q to 3Q growth without adjusting Prime Day, you invent a slowdown management says is not in the customer data. They say engagement and first half trends are continuing.
Risks they put on the table. Memory inflation already forced the CapEx raise. Fuel and line haul inflation and fulfillment. The one time benefits in 2Q will not repeat the same way. Tariff refunds were the significant majority of what they expect, and they largely absorbed tariff costs, which is why prices stayed about 14% below other retailers on the third party check they cited.
AWS pricing is subtle. Existing deals lock price for the term. New deals reprice with today's inflated inputs. Returns can stay stable if they underwrite correctly, but it is execution heavy while they are still short capacity.
Open questions I am carrying. Does the middle of the AI barbell, those enterprise production workloads, actually inflect over the next several quarters, or do we stay lab and run away, app heavy longer than the bull case wants? Can they keep AWS margins healthy while AI mix rises and CapEx stays elevated? And on stores, is same day perishables still compounding basket size and frequency, or was this the easy anniversary of the rollout?
Watch items for me, AWS growth rate, and whether those sequential revenue adds stay exceptional. Backlog versus that 496 billion base. Any color on 2027 and 2028 capacity reservation. CapEx cadence versus the 220 billion year. Bedrock and AI run rate commentary. Graviton and Trainium adoption, including any real move on third-party Trainium. On commerce, perishable active customers, same-day mix, and whether international margins keep grinding higher.
Bottom line, three numbers define the setup. One, the $1 trillion AWS long run ambition, anchored by a 169 billion run rate and a 496 billion backlog. Two, AWS margin expansion of 650 basis points year over year, still 520x the derivative, with AI supposedly tracking ahead of the old core path. Three, 2,300 cities with same day perishables and clear basket lift. Proof the commerce flywheel still has a physical growth vector while the company spends like a utility building the AI grid.
Bull case is they are early on enterprise inference. Capacity stays the bottleneck, not demand. And return on invested capital shows up as data centers fill. Bear case is CapEx stays heavier for longer. Free cash flow stays suppressed. One-time items flattered 2Q, and the middle of the barbell is slower than the rhetoric.
Either way, the call was unusually direct on demand, backlog, and why they will keep spending. Next quarter, we want proof the underlying store's trend holds after the Prime Day noise, and that AWS acceleration is not a one quarter capacity release.
This is discussion and analysis for entertainment and education, not financial advice. Do your own work.
Thanks for listening and watching. We will see you in the next video.